Hi, this is Sadiq Adesha, Chief Investment Officer for Sun Life Global Investments. During these strenuous times of extreme market volatility, it is important to put events in context and take a longer-term perspective. Setting emotions aside, clear heads and rational thinking prevails, and it becomes possible to shift from fear to opportunity. Join us in our Quick Take series, where we look at the impact of COVID-19 across various world regions and discuss how our sub-advisors are responding.
Hello, I'm Michael Wu, Investment Product Manager at Sun Life Global Investments. Today is March 17th. I'm joined by Product Specialist Peter Loncto from MFS to discuss his view on today's market environment and how the Sun Life MFS International Growth Fund is positioned in times of heightened volatility. Peter, can you tell us about your views on what's happening in the markets?
The sell-off in global equities has intensified since late February as this virus has spread globally. Investors are obviously concerned about the impact from the coronavirus on global growth, as well as individual company earnings. Initially, during this sell-off, we observed a rather broad-based equity market sell-off, but just more recently, we have seen increasing dispersion, which reflects the significant risk to the global economy. That is to say that companies and sectors with bigger economic sensitivity, such as financials, transports, industrials, and deep cyclical areas such as energy and mining have seen greater sell-offs. Additionally, balance sheet risk has also been a differentiator recently, with companies that are more well-capitalized, companies with healthier balance sheets, have generally held up a little bit better than the overall market. The energy sector has been notably weak, and that reflects the expected economic slowdown, as well as Saudi Arabia's recent decision to cut oil prices. Fortunately, from the perspective of the International Growth Fund, that has had a long-standing underweight to the energy sector because many of the energy stocks typically do not meet our investment criteria of sustainable growth and returns over a full market cycle, trading at attractive valuations.
Have you changed the positioning in the fund?
No, there have not been material changes to our investment strategy and our portfolio positioning. Since the concerns over the coronavirus intensified in mid-February, our trading has not increased significantly. However, we have found a select number of opportunities to sell and to trim some names that had held up very well in relative terms, and we've reallocated the proceeds to stocks where valuations had become attractive, and those stocks that have typically exhibited very strong downside protection characteristics. I'd say that while the level of uncertainty remains extremely high, we continue to focus on the durability of the companies we invest in, and we maintain that long-term perspective. In this environment, we are paying particular attention to companies' ability to generate high amounts of free cash flow, paying attention to companies' financial leverage, and assessing what their supply chains look like. I might add that that is something we had been doing for a couple of years now. Supply chains have been under the intense spotlight given what was going on with Brexit and with the US-China trade negotiations. So overall, we have continued to monitor potential impacts on a company-by-company basis. We continue to rely very heavily on our global research platform, and our analyst work incorporates macro, market, and tail risk events into our analysis, but while being mindful that rising volatility and market drawdowns can also create opportunities for patient long-term investors.